Hi folks, this is Sean Hyman from Chart of the Day, and I want to talk to you about why we trade with the trend in the Currency Cross Trader service. Your bigger moves will be with your trend. The trend is downward, as shown by this black moving average line. That's a 200-day simple moving average, or SMA. We happen to be on the dollar yen daily chart, going back about a year in time. Any charting package will have a moving average on it. You can go to the indicator list, wherever that is on the different charting packages. They'll appear at different places, and choose simple moving average. It'll ask you for your parameters. You put in 200, hit enter or OK, and it will plot this line automatically for you. I call it trend on training wheels, meaning it's the easy way to figure a trend and to know what direction is, because it's telling you how it's done. In other words, you don't have to even know how to draw your first trend line. It plots this automatically for you, and there's no way that you can mess it up. That's what I love about it. I think simple. I like things simple. I don't like to overly complicate things, so I love moving averages because they take care of the trend for me. So here the trend is clearly down, and that means that there will be more price action and momentum to the downside than there will be to the upside, and that's what's bringing it down over time. And that means that if we go with the trend and sell short when we get sell signals, that we'll have greater moves in duration, time and depth, number of pips in other words, and we will be with the momentum, with the order flow, and not against it. Why we do not trade counter to the trend, I want to show you here. Let me pull this up. Same chart. I've just drawn some boxes on it. Counter trend trading is when we've got a downtrend and we're trying to buy or catch a bottom, which is a no-no for professionals. And the reason is because when this came down into, and this is the slow stochastics that I'm looking at, and I've got a 14.33 settings, or what those are on. When this came down into oversold territory, people would normally go buying it up, so they would go buying it down here in this first dip. The only problem is it would hook over and go even lower, and you're losing money at that point. Here's an even worse picture right here. This comes down here and becomes oversold and stays that way for a while. We could have shorted, really anywhere in here. Could have bought anywhere in here with a technical oversold reading, and would have had this thing just, really rip into us, for hundreds of pips against us before even snapping back. And even when it does snap back, it doesn't snap back to our potential entry point. So that's one of the dangers of counter trend trading. Again, it comes down into oversold territory again. Had we bought, it slumps over even further before snapping back as well. So it's best to have your entries aligned on the side of the trend, and that's going to help you filter your signals. And so first you should say, what's the trend? Second, you should say, what's the indicator saying about the trend? So when your moving average is pointing down, look for sell signal entries only. Now you can exit on a counter trend signal if you want to, but only enter on a signal that is going with the trend. Had this been an uptrend and the line would be sloping from the lower left to the upper right, then we would enter upon buy signals, and we would ignore sell signals for entries. So our entries are always with the trend. We don't want them counter to the trend. These are what we call high probability trades. Anytime that you're doing something with the trend, it's a high probability trade. Anytime you're doing it against the trend, it is a low probability trade. So I've seen traders say sometimes, well, this indicator doesn't work, or it doesn't work any better than flipping a coin. And the reason why they say that is because they will put their focus down here where the indicator is, and they won't put their focus where the trend is. The indicator does not know that this is sloped downward, and it's assuming it's fairly sideways. And so when it's sloped downward, you have to, as the intelligent human, know to skew your signals towards sell signals and downtrends, and skew it towards buy signals and uptrends. And then you will find that the indicators actually work quite well. Now, had we been in a sideways range where everything was just straight flat, it was just wasn't going overall up, wasn't going overall downward, and it would be trendless, then we could take either signal for buys and sells. And so that's why sometimes people say, man, so many months ago I was hitting it, and I mean I had hit a buy entry, and then later on I'd hit a sell entry, and I mean every signal just about was doing good. And then all of a sudden it was like the indicator quit working on me. Well, again, their focus was here. Their focus wasn't here in the price action, and so that's why they go through these times where it appears that the indicator works well at certain times and doesn't work well at others. It's because trends change, and they don't notice a lot of times when the trend changes from downward to upward or downward to sideways, and vice versa. So that's what they got to keep in mind. Pros always trade on the side of the trend because it's the higher probability trade. Is statistically more apt to work in their favor and be reliable for them. And if you'd like to find out more about our Currency Cross Trader service, I'd just like to encourage you to go to worldcurrencywatch.com. You can click over here in the on the services tab over here to the left. Once you click there, it'll take you to the list of services. You can scroll down here to Currency Cross Trader. Click there to find out more. You can click there to subscribe. That's how you can find out more about us. Is under the services and our other currency letters as well. Thanks so much for watching, folks. Bye bye.